Ever wonder if a company is actually making money? You see their ads, you see their products, but are they profitable? Well, the answer to that is a story. And today, we're going to learn how to read that story, which is told through one of the most important documents in all of business, the income statement.
So let's be real. How do you actually measure a company's success? Is it how many followers they have on social media? Or how cool their brand is? I mean, those things are nice, but for investors, for the people whose money is on the line, it always comes down to the numbers. And that official scorecard, that's the income statement. You can think of it like a report card for a company's performance over a specific time, say the last 3 months or the last year. It tells the whole story, from the very first dollar that comes in the door all the way down to what's actually left in the end.
And at its heart, the entire multi-page income statement boils down to this, one super simple equation. You take all the money a company brings in, that's revenues and gains, and you subtract all the money it spends, expenses and losses. Whatever's left over, well, that's the bottom line, the famous net income. This simple formula is basically our roadmap for today.
All right, so here's our game plan. We're going to start at the top with revenue minus cost. Then we'll figure out operating income. After that, we hit the famous bottom line. We'll even look at what lies beyond net income. And finally, I'll show you how to read between the lines. Let's do it. First stop on our journey, revenue minus cost. This is where it all begins, right at what they call the top line of the income statement. We're going to take all the sales a company made and subtract the most direct cost of making those sales happen. Now, that direct cost has a special name, the cost of goods sold, or COGS for short. And here's the thing, how you calculate it completely depends on what the company does. If you're a retailer, like a clothing store that just buys sweaters and resells them, it's pretty straightforward. But if you're a manufacturer that actually makes those sweaters from scratch, oh yeah, it gets a lot more complex. So for a retailer, it's actually pretty intuitive. You look at how much inventory you had at the start of the year, you add all the new inventory you bought, then you subtract whatever's still on the shelf at the end of the year. The number you're left with, that has to be the cost of the stuff you sold. See? Simple enough? Okay, but for a manufacturer, it's a whole different ballgame. Buckle up. Step 1 is just figuring out the cost of the raw materials they used. You can see it uses the same logic as the retailer. You take the raw materials you started with, add what you bought, and subtract what's left. That gives you the cost of just the direct materials that went into production. But of course, materials don't just magically assemble themselves. So, step 2, we have to add the cost of turning that stuff into an actual product. That means adding in the direct labor, the wages for the people on the factory floor, and manufacturing overhead, which is all the other factory costs, like rent, electricity, you name it. That gets us the total manufacturing costs. But we're not done. Think about it. A factory always has stuff that's only half built, right? That's called work in process inventory. So in step 3, we have to account for those partially finished goods to figure out the cost of everything that was actually completed and rolled off the assembly line this period. This gives us the cost of goods manufactured. And here we are, the final step. We take that cost of goods manufactured, and then we do one last adjustment for the completed products that were just sitting in the warehouse. Once we account for that finished goods inventory, we finally get our big number, the manufacturer's cost of goods sold. I know, it's a process, but every step is crucial to get that precise number. So after all that work, we get to our very first major milestone on the income statement, gross profit. All you do is take your total sales and subtract that cost of goods sold we just spent all that time calculating. And this number is a big deal. It tells you how profitable the company's actual products are before you even consider any other corporate expenses. Okay, so we know if the product itself is profitable. But what about the cost of, running the company, the marketing team, the accountants, the CEO's salary? That brings us to our next section, calculating operating income. These day-to-day running costs usually get split into 2 buckets. You've got your selling expenses, which is everything you spend to market and move the product. Think ads, sales team commissions, and shipping. And then you've got general and administrative, which is basically the overhead to keep the lights on. Office salaries, legal fees, stuff like that. So if you look at a common type of income statement, called a multi-step one, it lays this all out really logically. You can see right here, we take that gross profit number we calculated earlier, and then right below it, we subtract out all those operating expenses. And that subtraction brings us to an absolutely crucial metric, income from operations. Why is this number so important to analysts? Because it tells you exactly how profitable the company's core business is, its main reason for existing. It cuts out all the other noise, like weird investments or taxes, and just gives you a pure signal of performance.
All right, we are on the home stretch now. We've handled the core business, and now we're heading for the famous bottom line. This is where we account for all the miscellaneous stuff. Things not related to the main business, taxes, and any weird one-off events.
And you can see how we get to the finish line right here. We start with our income from operations. Then we factor in any other revenues or expenses. This could be things like interest the company earned or paid. That gives us income before taxes. And then, of course, Uncle Sam gets his cut. We subtract out the income taxes, and there it is. We have finally arrived at the bottom line, net income.
Now, here's a quick side note. What happens if a company does something massive, like selling off an entire division of its business? Well, that's not exactly a normal, everyday event, is it? To avoid confusing investors, accountants have to report the gain or loss from these discontinued operations on its own special line, keeping it separate from the results of the business that's, still operating.
So you might think, okay, net income, that's it, story's over. But hold on, it's not always the complete picture. We need to go beyond net income to look at something called comprehensive income.
This is where things get a little interesting. There's the special category called Other Comprehensive Income, or OCI. These are weird gains and losses that, for accounting reasons, don't belong on the main income statement, but they definitely still affect the company's overall net worth. The classic example is a gain or loss you have on paper just because the exchange rate for a foreign currency changed.
And here's how it all fits together. You just take the net income we worked so hard to calculate, and you add or subtract these OCI items. What you get is total comprehensive income. For serious analysts, this is the most complete view of every single thing that affected the company's financial value during that period.
So, before we wrap up, it is so important to know how to read between the lines here. Remember 3 key things. 1. Profit is not the same as cash. A company can report huge profits but have no cash in the bank. 2. These numbers rely on estimates and judgments made by management. And 3, as we just saw, not everything hits that famous bottom line. The income statement is incredibly powerful, but you have to know its limitations.
Which leaves us with one final big question to think about. The income statement does an amazing job of telling us what a company earned over the last year. But does what it earned in 1 year tell us what the entire company, with all its assets and history, is actually worth today? That, my friends, is a story for a whole different financial statement.